Hi, I'm Shae Russell from ABC Bullion, and joining me today is Nick Frappell, Global General Manager of ABC Bullion. Nick, how are you today, mate?
Very well, thanks, Shay. Good to be chatting again.
Yes, it's nice to see you back. And it's a coincidence that both of you, you and I, happen to be wearing the exact same thing we wore last time. So
I
hopefully
know.
everybody can forgive us for this transgression.
Yeah. It's we have actually changed different clothes, since the last time. It's just that the cycle matched perfectly.
I think it's lockdown life. It's more of a case of, look, that's the iron shirt we've got, and that's the one we're going to use.
Exactly.
All right. Now, I shouldn't dawdle too much into chit chat with you because we actually have a lot of topics we want to go through today. Now, first and foremost, we are going to kick off with Jackson Hole. Now, every August, the Federal Reserve Bank meet in Jackson Hole. Now, arguably 10 years ago, this was considered an academic flex. They put out
Mm.
interesting thoughts, whereas now Jackson Hole is more seen as an insight into monetary policy from the Federal Reserve Bank. So tell me, what are the key points that came out from Jackson Hole on Saturday morning Australian time?
Well, to me, the key point is that Jerome Powell wasn't as hawkish as Richard Clarida, the vice chair, and Eric Rosengren, the president of the Boston Fed, who'd been really sort of sounding some kind of hawkish drums in the 2 weeks prior to Jackson Hole, and kind of looked like they were preparing the ground for a fairly by Fed or central bank standards, a fairly clear exposition of when tapering would begin and perhaps a little bit of a clue as to the tightening that would follow that. And actually, Powell sort of split the difference a bit. He was dovish and he repeated his claim that just because you taper doesn't mean you tighten. There's a more stringent set of outcomes that you hope for before you tighten. So it was kind of, well, if you were long of equities, it was positive, but probably to a lot of the rest of us, it was sort of disappointing because you kind of were hoping that there'd be a little bit of clarity around where we're going with monetary policy in the States on the basis that where they go, pretty much the rest of the world follows. So it's probably worth just saying a couple of things about why Jerome Powell sort of stuck to that fairly dovish interpretation. And before I sort of explain that, what I thought came out of his speech, just probably worth pointing out that it's not an endorsement just because I'm trying to explain what he says. It is what I think he's saying, and so on. But his view, if you like, his thesis was that the really long-term macro deflationary pressures that have been operating for the last 2 decades will still remain largely in place post-COVID. And so those big deflationary pressures will, things like demographics and productivity and so on, they will still remain in place. We should sort of, still think that we're living in a deflationary world. The other thing that he was mindful of is times when the Fed has tightened before when it shouldn't have tightened. I mean, going way back when, I think in the 50s and 60s, and he's looking at the Fed acting too quickly then and saying, look, we've got a lot of slack in the labor market. If we tighten too quickly now, we'll actually dent America's growth prospects for a long time to come because we'll actually damage the long-term capacity of the US economy. So that's kind of where he's coming from. It's a very considered, slow-moving macro outlook. And it was a little bit of a surprise, perhaps, in the sense that what people like Richard Clarida, I think I'm pronouncing that correctly, was saying in the 2 weeks prior. They were saying, listen, we've hit pretty much all the necessary expectations and hurdles in this fast-growing economy. We really need to say that tapering is happening, and tightening will happen shortly after. Tapering, I think, will happen. It's just that it was just a soft-sounding, dovish comment. Obviously, you can see the consequences for the dollar and the gold that we'll talk about next, I'm sure.
Actually, that's exactly where I'm going to. We are going to touch, you did mention something on equities in there before, so we are going to touch on that towards the end of the conversation today. But look, let's be honest, towards the end of last week, gold didn't do anything. It was the gold market was quite muted, I should say.
Yeah.
So since the Federal Reserve meeting has ended, we have seen that pop in the gold price, and with the gold price sitting at around $1,815 US per ounce. Tell me, how has this movement changed your view on gold and where it's going on the back of the Fed's comments?
Well, it's certainly more positive at higher levels, but to me, the important levels that you have to get through 1831, 1833, for two reasons. Firstly, that's where gold struggled before in the last month or so, and it's sort of banged up against that level three times or something. The other thing is that from a technical level, I think the daily Ichimoku cloud we're still sort of going up through that cloud, and that I think that daily cloud top comes in at 1833. So there's a sort of a technical sort of resistance there, perhaps not a hugely strong one, but to me, below 1833, 1830, say, that isn't really an important, we haven't had that breakthrough. Saying that, we're above, certain other moving averages and so on. So clearly it looks a lot better. I think the other thing is, as well, as if you look at the sort of recent driver dollar correlations and so on, I've been pretty bullish about the dollar sort of through the first half of the year and really up to now. But that dovish comment was probably not great for the dollar. I don't think it's still in an upward trend, sort of short to medium term. It's doing okay, but that's a dent some of my confidence in the strong dollar thesis. I think perhaps the word rather than dent might be delay. Because it's definitely sort of put a little bit of a roadblock or a barrier there. But look, so below 1830, look, we could fall back a bit, but the stars are sort of aligning for a push higher, and you'll really see 1830 and above. That's the important point where you can be more confident about a gold rally.
Now, before we move on to a couple of other topics I want to cover today, I do just want to talk a little about silver. We can't forget that silver is a very important precious metal. Now, you've just made comment there that gold is above moving averages, and gold is currently sitting above each 200-day moving average. But silver isn't. Silver still, hasn't got the same sort of pop that gold got in recent days. Tell me, what's your view on silver? Is it due to get the same pop as gold? And why is it stuck under this average or moving average?
I'm not really sure why it's stuck, because the last month or so has seen a reasonably good arrival of some fairly decent longs. So the silver markets seeing net it's not particularly strong, but we got some longs flowing in 2 or 3 weeks ago, slight reductions in the week ending August 24th. So look, it's for a long time, or for a certain while, silver was looking better than gold. That's flipped somewhat. I think when we had our last discussion, we talked about the gold-silver ratio moving to the high 70s or mid to high 70s. That's happened. Mid to high 70s is probably, I wouldn't expect silver to carry on with that relative underperformance. So I'm fairly fond of silver. I think it's got scope. The important thing is that on the recent decline, silver hasn't gone through any levels which change that bullish outlook. So a bit of patience with silver, but I think it's bullish. It's below certain key levels which it sort of hasn't touched yet. That silver is looking, like it's still got those big long-term targets. Below about 2170 or so, that would be questioned quite aggressively, but we haven't got that level. So I still like silver. It's underperformed relatively. I think it can catch up.
Oh, that's good for the silver lovers out there.
Yeah, absolutely. And actually, just going back a little bit to gold and talking about positioning, for gold. If you look at the week, August the 24th, saw a little bit of buying back from shorts, saw a little bit of buying from longs. Nothing really special. But if you look at the gross managed money longs, it's just a proxy for investment demand. It's about 12 and a bit million ounces. That's pretty low. So the scope for money to sort of flow into that space is quite high.
So I'm going to move forward now to the Aussie dollar compared to the US dollar. Now, you actually called the Aussie dollar weakness quite recently, but the Aussie dollar sort of, bust out of the gates. And I think for a lack of a better way of phrasing, it's moved from a low of 71.50 to, at the time of having this conversation, sitting around the 73.20 mark. So, I know we normally talk about gold, but what do you see driving the Aussie dollar right now? Because it seems to be strengthening in recent days.
Yeah, it has. And I think that's partly because it's achieved a couple of targets down to the sort of 72 and the high 71 levels. Having achieved those targets, it's now rolling back and looking at, it's natural that it should have some strength. The other thing is people are quite short the Aussie. So those shorts and I think they've entered the market at really good levels. If you look at where the short positioning increased and the volume weighted average, they look like they've entered the market at good levels. So they've got to be thinking at some point about taking some money off the table. So I think there's an element of that about. The other thing you've seen some pretty good commodity pricing. Not only the price of gold improving, aluminium is looking good, and the recent drop in iron ore actually touched a really important technical level. It went right down to the weekly cloud top. It's then rallied and it's stopped. It's kind of pausing at the moment. It's rallied about 38% of the whole July-August drop. So that kind of tells me, maybe that's just a little bit of a technical bounce, if you like, off that support level. But nonetheless, after having a pretty desperate month, iron ore's come back a little bit. The things that really matter, I think, though, for the, apart from high commodity prices, of course, is you've got the ongoing lockdown. Sydney is a quarter of Australia's total GDP. Victoria, obviously extremely important too, probably almost as important, I'm sure, GDP-wise. So you've got these two areas that are in lockdown, high levels of the relentless spread of COVID and so on, lockdown sort of set to continue. That's not great for the Aussie. This is maybe more of a reflection of a weakening US dollar rather than a positive Aussie dollar. If you look at levels, having said that the Aussie kind of recovered from that 38.2 fib level, if we go back down through there on, say, more bad news, then I think the level, I'm hopefully not going to forget here, but it's something like sort of 67.5, which would be halfway, retracing the huge rally we saw from March last year. That'd be the 50% point. And that would be, I would think, a major interim low for the dollar. I expect more than that. But given that there is bad news about lockdowns, that's, could happen. The other thing is, of course, is what's going on in China, which is a little bit difficult to figure out, but you've got a lot of, sort of government regulation. This has been going on for weeks. The government regulations damaging the sort of tech stocks and so on, and various sort of levers being pulled and so on domestically. But you've also got signs there within the economy of weakening property demand, weakening output and so on. It's nothing major, but you've just got signs of various indices are telling you that China is softening.
Look, Nick, you touched on a great comment in there, which is about iron ore and the Ichimoku cloud. Now, I know this is primarily a gold channel, but one of these days, yes, I'm going to try and tempt you to run your technical analysis across some broader commodities, but we are rapidly running out of time to delve more into that. Before we wrap up, you talked about how equities went on a little bit of a rally in the US, once again on the back of Jackson Hole. So yes, you've got some fun facts to share with everybody. Well, I suppose they're not necessarily fun facts, but they certainly are interesting, about what we're seeing in the S&P 500 in the US and US equities in general.
Yeah, well, the thing is US equities have had an amazing run, a huge run. So it hasn't paid to be out of them in any way. But at the same time, you've got to kind of like look a little bit to windward and sort of think, well, what could, end or thwart this sort of, massively good run. And, there's kind of no point in saying, we all know the metrics and the valuation's really stretched. But a couple of things that sort of a lot of people are talking about lately, which is really unscientific, but just kind of, if nothing else, interesting to observe is the huge number of all-time highs that are being made on the index. And I think as many all-time highs have ever been made in any bull run, whether 1929 ominously, or the dot-com sort of bull run of 99, 2000 and so on. And some really, really interesting graphics and tech that's sort of coming out about that. The other thing that's is interesting and perhaps a little bit more robust, if you like, it's not just counting all-time highs, is that the rate of growth of money supply globally is actually slowing. And the rate of growth, either increasing or otherwise, is a bit of a leading indicator for the subsequent levels of the S&P. So just something to be aware of. I'm certainly not, like doom mongering or sort of calling anything, because people have been doing that for a long time and wishing they'd sort of stayed long or whatever. But just an interesting, perhaps a interesting factoid or an interesting scenario to keep your eye on.
Look, Nick, that is a great little fact to finish on for today. Unfortunately, we've run out of time. So I think we should do this again in 2 weeks, but perhaps you and I should put different shirts on.
Absolutely. Yeah.
All right,
Thanks
Nick,
very much.
We'll leave it there. Thanks for being here today.
Cheers. And you.
Yeah.